Good afternoon, everyone. I'm Pamela Hastings, Relationship Manager at Barometer Capital, and thank you so much for joining us on another Tuesday afternoon for our Barometer Readings webcast. Joining me today, as always, is David Burrows, our Chief Investment Strategist, who will break down the market as we see it and provide further guidance to all of our viewers out there. So we're looking forward to hearing what he has to say. The market has been doing a bit of a dance lately, 2 steps forward, 1 step back. The Fed was active today. And so Dave is going to walk us through what and how the market has reacted to that information. So looking forward to David's update. And of course, we'd be pleased to address questions at the tail end of the conversation. So don't be shy. You can email me at phastings@barometercapital.ca or hit me up on the Zoom Q&A or chat. And with that, on this 7th day of March, I turn the conversation to our one and only David Burrows. Good afternoon, David.
Hi, Pamela. How are you?
Great. Thank you so much. Looking forward to your webcast.
Great. Well, thanks everybody for joining us. It has been sort of 2 steps forward, 1 step back over the last bit. Market continues to wrestle over, on one side, relatively strong economic data. On the other side, a Fed that has been trying to calm and tame inflation. I think that the Fed has had some frustration and that they've seen some data get a little bit better on the inflation front. At the same time, employment remains very firm and not showing any signs of weakening. Our question may be, is it possible that the economy is strong enough to bear some of these higher rates, while some of the inflationary pressure that has come from the supply chain starts to ease? We know that inventories have started to build. That's a positive. We had low inventories in a lot of products. But at the same time, we have continued to see strong employment. So today, the Fed was speaking in front of the Humphrey Hawkins hearings in Congress, answering questions. He moved away from his disinflationary talk that he made in the last Fed meeting to say that, inflation continues to be sticky. I think that the bond market was listening. The short-term bond yields went sort of sharply higher today. But with that, long-term bond yields actually came down a little with a view that maybe with stronger short-term rates that they do work at taming inflation. So the market keeps going with this dance. So what I'm going to do today is I'm just going to talk through from a high level what we're seeing going on. What I obviously say is I care a lot more about how the market reacts to the news than the news itself. And to be honest, with the sharp move higher in very short-term yields today, the move down in equities was not particularly accented. They certainly pulled back, and more economically sensitive groups certainly pulled back. But we're going to ask the question today: is the current leadership continue to be in place? Are there changes taking place? Are people moving toward more defensive equities or to more defensive assets? And so we'll go through the step by step. As always, our basic view is that our job is to identify the parts of the market that have a structural positive backdrop, where we're seeing either expanding multiples or improvement taking place that can support higher prices. We don't have to be everywhere. People can go and buy an index fund and pay 0 for that. I think that our job is to pick and choose our spots, to target areas that are constructive, that have a long-term structural theme in place. And then continue to ask the question, is anything changing? Is there new leadership that's emerging? Is there old leadership receding? Should we be making changes to the portfolios? Do they continue to be lined up with the current market environment? Which means that we're always making small adjustments sector to sector. We're always making use of some portion of cash in the portfolio, either to defend us or put it to work to take advantage of the situation. And in the event that things really start to correct or show us weakness under the surface before it's obvious, get defensive, because we have no problem being on the sidelines. So this is really quite a tactical approach. We're really trying to pick our spots. Just going from a high level, we continue to believe we're in a structural bull market in equities. This is the U.S. stock market as represented by the S&P 500. We've commented now for weeks and weeks and weeks that so long as we stay above this rising 200-week moving average, our belief is we're in a structural bull market. It was the way all the way through the 80s and 90s. It was the way all the way through the 50s and to the middle 60s. And it's been the way since 2013, rising above this rising 200-week moving average. We briefly touched on it and tested it in October. We pulled back close to it again in December. And here we continue to remain above. Over the course of this month so far, the S&P up about 0.71 of 1%. These are all monthly bars. And it really looks very different than what a structural bear market looks like, which like this period 2000 through 2013, where the S&P made no progress, crisscrossed across this 200-week moving average several times. It doesn't mean that these markets that chop around are comfortable. They're not. The reason that markets correct is because there's less conviction in shareholders' minds. But certainly the reason that we care is that in between these structural corrections, you get these long runs in price. And we want to take advantage of them as best we can. We know that over a long period of time, stocks have been a pretty good place to be. So equities, we believe, continue to be in a structural bull market. On the other hand, we think that bonds are in a structural bear market. We've seen falling interest rates from 1981 to 2020. It's a long time. That's 40 years. And from that point, we moved from a low of 0.4 of 1% in 10-year Treasury bonds to a number substantially higher than that, much like the turn we saw in rates in the late 1940s. And once that started, it went on for 40 years. There's the 10-year yields coming down over the course of the last 40 years, bottoming in 2020. Yields sharply rallied as we went through the COVID stock market rally. We continued to rally through the course of 2022's bear market in stocks, and this made it a very uncomfortable place for balanced investors, where a balanced account, stocks were down 20, bonds were down 20. That means that the balanced account, the average balanced account was down 20% last year. I'm particularly proud of Jim Skatakis in running our balanced mandate, which was down just over 5% in the worst year for a balanced account since 1931. So yields have been moving higher, and they continued today. This is the TLT, which is the long end of the US bond market. It peaked in 2020. From that to the low price in October of 2022 was down 48.7%. That's a massive sell-off in a long-term bond. It bounced a little bit, but as you can see, we've made a series of lower highs, and we did that again at the end of 2022, beginning of 23, and prices have continued to move lower. All the moving averages are headed lower. So our belief is it does not make sense to go and put money to work in the bond market when it may be that we are at the beginning of a multi-year rise in yields. It doesn't mean that there won't be structural bounces. You got to be pretty nimble to take advantage of those. The only thing that we think we would care about is very short-term bonds, like less than 1 year, if we're holding some cash at various points. We'll talk a little bit about that today. But there's the 2-year yield today hitting 5%. If we look at some of the expectations in the market, that the expectation is that short-term rates could peak at as high as 6%. So there is an alternative for very short-term investors to get a return in the sort of 5% range. In the end, if you take inflation out, it doesn't leave a whole lot after you pay tax, but we want to keep in mind that yields certainly have moved higher. If we compare the S&P versus the 10-year bond, we can see that even though in 2020, in the bear market, there was a few months you'd been better off holding 10-year Treasury, in general, stocks have outperformed pretty consistently, and they continue to. So we know that day by day we get ups and we get downs, but these are monthly bars. And over the last 2 years, and in fact, over a very long period of time, stocks in general have been a better place to be. That continues clearly to be the case as we sit right now. Now, when we look at other asset classes, we talked a lot about commodity prices having been in a bear market from 2008 through 2020. They reversed that in late in 2020, beginning of 21, and for the first time in a decade, outperformed stocks. And certainly they outperformed until June of last year, and then they consolidated for a period of months. And that would be expected. We needed to see the long-term, the very long-term moving average turn higher. And now we are very clearly in an uptrend, and we've consolidated those gains, but maintained them over the last number of months. If we compare the DBC, which is the broad-based commodity ETF, to the S&P, same thing. We reversed underperformance by commodities versus stocks in 2022. It was the only asset class that was up for the year last year. But again, it's consolidated since May of last year. And my guess is we're getting probably ready to see continued outperformance. Moving on. Commodities versus the TLH, which is the bond market. Again, started to outperform for the first time in 2021. And again, over the last number of months, consolidated those gains. So stocks over bonds, commodities over both stocks and bonds, bonds being the weakest asset, commodities probably being the strongest. But again, we have to pick our spots within those asset classes. Now, this has been a really important chart. This is the US dollar index, the US dollar versus a basket of global currencies, including the British pound, the Japanese yen, and the euro. It has tended to be that when there was a risk-off attitude or people looking for safety, tended to be the US dollar would lead. And of course it did, all the way until stocks made a low in October when it rolled over. And we know it pulled back through the point where stocks rallied since then, broke support, broke the 200-day moving average, and over the last few weeks has bounced. And it is bouncing up into sort of important resistance. First of all, the support level it broke when it dipped below kind of 106 and below this 200-day moving average. This is an important battleground. Today, when the Fed talked about potentially more restrictive rates, the US dollar bounced again a little bit. So this puts pressure on risk assets, and that's why stocks pulled back a bit. But frankly, given the magnitude of the market's expectations for higher rates, the implications for stocks were really not that significant. But we'll see whether we continue to stay below this resistance and below the 200-day moving average, or whether that reverses. That's the battleground we're watching most closely. Now, for our decisions, we have a very specific set of lenses we look through. We have a process we've used forever. The baseline premise is that 70% of return comes from getting to the right neighborhood, being in asset classes that have a tailwind. So right now, that means stocks and commodities. Identifying sectors and themes within those groups that are right for the current environment where we're seeing net inflows of capital into those groups, which are supportive of prices. And then we want to find specific securities within those groups that help us to express our view and build a portfolio. We have a top-down model where we take a very broad universe of securities, looking for characteristics that point to securities that are good, getting better, where the fundamental characteristics, the financial characteristics, are showing net improvement, and where prices for those securities are behaving the way they should be given what we think we know about the fundamentals. So strong fundamentals and strong technicals. We run that process every day, and we always have a list of securities that meet those tests. We call them our farm team, things that we'd like to own. But given the fact that you can buy a great house in a bad neighborhood and lose a bunch of money, we need to understand that we're focusing those securities in the right areas. So from a top-down perspective, we take all of the various asset classes and sectors and themes that we follow, try to identify those groups that are seeing net inflows of capital, and where we can find securities that meet our business tests in areas of the market that are seeing net inflows of capital. Well, we're addressing each of these three key factors. That's where our portfolio should live. Now, the reality is that a portfolio is a living, breathing thing. We always have to reassess all of the holdings that we have every day to recognize if perhaps one of the groups that we've been focused in stops working, or if one of the securities that we've identified as a way to express our view misses numbers or starts to show negative change. And so the third piece of the process that's really important is our selling process. And we run stop losses on all of our positions. That's not the only reason we'll exit a position. If we think something fundamentally has changed or a specific group has gone out of favor, that's a reason to exit. But from a price perspective, we've always got a stop loss in place. And as a position works out as we hope or expect, we ratchet the stop loss up and behind. So it lets us stay in our winning positions as long as they work. And when they stop working, they come out of the portfolio, with a little mistake, not a big mistake. So that all being said, we're always about finding areas of the market that are showing expanding breadth. That is a healthy characteristic. Over time, if more and more stocks are participating in a group, that's healthy. When deterioration in breadth starts to take place, the weaklings under the surface start to sell off. That tells us that there isn't enough new money coming into that group, or there's enough money leaving, where the risk reward levels have changed. And that causes us to reduce our exposure, to stop putting any new positions on in that group. And I examine that every week in this meeting. So let's take from a high level. The percent of stocks in uptrends in Canada has been improving since October and continues to be solid. I checked today in our morning meeting. We are actually at very close to a new high in breadth in the Canadian universe of securities. Interesting, because it's an area that over many years we didn't focus as much in, but over the last year, certainly we have focused more. In the NYSE, the percent of stocks in uptrends has backed off over the last 4 weeks, and it's backed off about 10%. So about 10% of all the issues on the NYSE have given us net new sell signals, but we continue to have close to 60% of stocks in the NYSE in uptrends, or 6-4 up versus down. And so there's lots of things that are doing well, but it does mean we're not putting on new positions currently in the US. Our existing positions, we continue to question every day. We follow our stops, and thankfully our positions continue to work pretty well. Globally, breadth for equities continues to expand. Now, this is interesting, and I'm going to talk about this today. We are seeing interesting strength in markets that have not performed well for a long period of time. And this tool is very useful to us to take away our preconceptions, to help us to see what is happening, not what we think should be happening. In our short-term indicators, the US indicators have been weakening a little bit. Percent of stocks with positive weekly momentum actually has come down quite a lot. I'm going to talk about that in a moment. Percent of stocks with the 50-day moving average is sitting at about 50%. Same thing for global equities. So in the month of January, we had a couple of very strong breadth weeks. And when these things happened, it has tended to happen at important market turning points. We talked about the fact that the forward-looking returns were very, very favorable when we had these things take place. But we know things don't go in a straight line. This chart tracks the percentage of stocks in the NYSE with positive weekly price momentum. What does that mean? It doesn't mean stocks going up or stocks going down. It's stocks with steady upward trajectory. And we know when we get to a high percentage of stocks performing with upward trajectory, it often corrects back down to a low percent. And you can see that in January, we started January with 20% of stocks with positive weekly momentum. And then by February, 80% of stocks had positive momentum. Now, you can see if you go back over the last several years, these tend to peak out when we get up into the 80s and 90s. And then they correct because stocks don't go straight higher. And we pull back to levels down in the low teens or 20s. So we've seen since the beginning of February, percent of stocks with positive momentum, as they typically do, go from being maybe overbought in the short run to maybe oversold in the short run. So I think this is encouraging because when we look at the price chart for the S&P, it continues to be quite favorable. At the lows in October, 10% of stocks were in uptrends. The market rallied, and we pulled back through December. By mid-December, we made a secondary low at a higher level, but by then 42% of stocks were in uptrends, and we held there and rallied off it. By the end of January, 55% of stocks in the S&P were in uptrends. Then we pulled back again as the US dollar rallied, back toward the 50-day moving average, the 200-day moving average, and the downtrend that we had broken on the way up. Now, as of last Tuesday, we were testing that level. And here we are a week later. We rallied sharply on Thursday and Friday last week. Monday, we pulled back a little bit, and today we pulled back to the 50-day. This is all very constructive. This is how markets go through a bottoming process. I'd love to see it go straight higher, but it just doesn't do that. So we continue to be supported by pretty good breadth in the market. We continue to be supported by the moving average, which now is flattened out, the 200-day turning higher, the 50-day has turned higher. But again, we have to continue to wait and watch and see if there's change. So let's talk leadership for a moment. In the beginning of October, if we look at our sector leadership chart, all of the sectors were stacked at the left side of this distribution chart, meaning a very small percentage of stocks in general were in uptrends. They were virtually all in small letters, which means that breadth had been declining. The average sector had 24% of stocks in uptrends. And by the time we got into the end of January, beginning of February, it was a much different picture. The average sector had 54% of stocks in uptrends. The vast majority of sectors had percentage of stocks in uptrends rising, meaning we were all in capital letters. The broadest part of the market was dominated by industrials, materials, and financials. The weakest, even though they were getting a little better, was healthcare, utilities, consumer staples, the most defensive parts of the market. Well, let's fast forward to today. We know things pulled back a little bit through the month of February, but we continue to have a pretty broad-based market. The average sector, 46% of stocks in uptrends, but the character of the makeup is more important. The weakest performing parts of the market continue to be defensives, and in fact, they're getting worse. The strongest part of the market continues to be more cyclical or economically sensitive. The parts of the market you'd expect to get really hurt if the economic data started to collapse. Steel is the strongest part of the US stock market, with 76% of steel stocks in uptrends, and that continues to be firm. We have builders at 66%, that's home builders and construction materials. Industrials like machinery at the top end of the curve, financials, insurance, banks, and regional banks, and Wall Street, that's capital markets. Also from materials, we have chemicals, we have transports, oil and oil service. Again, pretty economically sensitive groups. We have seen a little bit of deterioration in breadth, so we keep that in mind. But in general, the fact that these are hanging in like they are is pretty attractive. So let's just talk groups. Financials pulled back a little bit. Probably the weakest group over the last 5 days in our leadership category have been financials. But again, let's test them on breadth. 36% of stocks in uptrends in October. By the time the market made a higher low in December, 50% were in uptrends. We got to 62% by the end of January. We're at 58% today. 4% of stocks out of 100 have given sell signals. Thankfully, all of the ones that we hold continue to act well. Again, breadth is pretty strong. The 200-day moving average has gone from declining, which means downtrend, to an uptrend. The 50-day moving average is rising. This continues to be a leadership group. We look at industrials. Industrials, the rising 200-day moving average, rising 50-day moving average. We're above the 50-day moving average. As early as Monday this week, gave a relative strength new high versus the market. Strongest it's been versus the market going all the way back to the spring of last year. And within this area, defensive stocks continue, the defense stocks continue to do well, but machinery also continues to do well. We talked last week about ATS automation as one of our larger positions, but we continue to like companies like Caterpillar and Ingersoll Rand. Materials as of Friday, again, made basically a new high going back to June when they started to correct. Where we were doing our webcast last week, we were testing the 50-day moving average. We moved sharply higher through the course of last week and have backed off some of the first 2 days this week. Again, higher highs and higher lows, what we want to see. Higher highs, higher lows, higher highs, higher lows. This is something we're watching. Certainly in this group, steel continues to be the best as of 2 days ago, made a new 52-week high. And yes, it pulled back over the last 2 days and filled this little gap that it left behind when it broke out last week. 10% in uptrends, 56% in uptrends, 62% in uptrends. Breadth is slowly improving. Moving beyond those top three groups, energy continues to make higher lows. We talked last week about the fact that when energy made a 3-month relative low versus the market, likely it was ready to rally, given the fact that we think it started a new bull market last year, the best performing part of the market last year. The Canadian group broke trend last week to the upside. We think that's positive, back testing that breakout today, but again, continued to make higher lows, all very constructive, rising moving averages. So these have been the strong parts of the US stock market. The strongest part of oil and gas has been oil service. And again, we made a 52-week high 2 days ago. Strong relative strength versus the market, and it's rising moving averages and rising breadth data. And then home construction, which we talked about off the top. So these groups, I think, continue to act well. They certainly aren't moving straight higher, but they are moving in a very steady pattern of higher highs and higher lows. So are there other areas of the market that we might want to focus on? So far, hard to find. Consumer staples, which are a group that people own when they think the economic data is likely to weaken, have been weakening sharply since the beginning of the year. Utilities continue to make lower lows and lower highs. And healthcare, same picture. These three sectors not eligible for new investment for us. So let's look at the groups. Financials continue to be the largest weight. From a sector perspective, next is industrials. We have a 9% weight in energy. We've been in some dividend paying, information technology companies or technology companies. These are largely large cap value, where we're getting a nice dividend growth. Companies like Cisco, which are not unprofitable tech with a promise of the future. These are cash flow generating assets. They're generating a nice dividend yield. But as you can see, we continue to have a very, very low weight relative to the index. Energy continues to be a significant overweight for the index. Materials that considers a considerable overweight. And those are really our big weights. But you'll notice that bonds have moved up in order. I think they moved up 4 spots. 18% of firm assets are in government bonds, but I want to be really clear here. These are very short-term bonds, like 6-month T-bills to 1.5-year bonds. They are a place to hold cash. Our cash went up a little bit this week. As you can imagine, there's been a little bit of sloppiness in the market, but this is just a holding place to get some yield while we let the market settle out and get past some of Powell's comments. At the bottom end of the portfolio, almost nothing in utilities, real estate, healthcare, communication services, and consumer staples. Consumer discretionary also continues to be a very low weight. So the portfolio continues to be really skewed. There are some areas that have shown some real resiliency, which are at the top of the portfolio. There's some areas that are not showing us any reason to do any fishing in these camps. And I think the basic message that comes away from this is that money continues to flow into reflationary sectors, sectors that benefit as the economy is stronger than people expect. Rising rates in a period of disinflation between 1981 and 2020 typically caused an economic accident because the economy wasn't strong enough to handle it. In the 50s and 60s, when reflation began, rising rates were able to be handled by the economy because there was a strong employment market and strong demand in the economy. We think we are closer to that place. Now, here's something that is supportive of that. We talked about this chart a couple of weeks ago, and it's a chart that highlights any time global stocks outperformed US stocks for more than 12 months, it tended to be the beginning of something longer. So if we go back over time, all these periods of light blue are where global stocks outperformed US stocks. And we know some of the greatest bull markets in history were in US stocks. I'm not disputing that. But we've just come off a period where in the last 12 months, global stocks have started to outperform US stocks. So I want to touch on that a little bit today because I think it may become more important. We talked about this over the last several webcasts that we in our macro portfolio have been building weights outside of the US. When I look at the breadth data or the breadth chart for all of the various regions in the world, you can see lots of green, but you do notice that breadth in the US has pulled back a little bit. We see pretty good breadth across Asia Pacific, pretty good breadth across Europe, Japan, and other various markets. Let's just touch on this a little bit. Europe Stocks 50 Index. This is an ETF, FEZ, which we own in our macro portfolio. Very nice breadth improvement, significantly higher low in December from the October low, and holding the gains very nicely against a US stock market that corrected some in February. Japan currency hedged. These are monthly bars continuing to work their way higher. And most importantly, as we talk about, when you come out of a multi-year period of consolidation to the upside, often you've begun a new long-term bull market. Not a lot of people talking about buying Japanese equities, but certainly we do have some weight in our macro portfolio, something certainly worth watching. Mexico making new multi-year highs as of Friday of last week. And Argentina has had a very good year against a very difficult global stock market, made new all-time highs. So let's just do a little comparison. If we take from the October 6th low in stocks, in green, the aggregate bond index is about flat. So that is an unweighted index of various issuers over various maturities of US bonds. So the US bond market has made no progress. The QQQ is up 5.8% since the October low. The S&P is up 6.7%. The Vanguard Total World Index is up 9.69. The Japanese stock market, even currency unhedged, is up 13%. Currency hedged, it's up more than that, 13.4. The UK market is up 18.9. EFI, which is Europe, the Far East, and Africa, is up 20.5%. Argentina is up 26. Mexico is up 28. And the Euro Stocks 50 is up 31%. So I think it behooves us to look at some of the global universes of stocks for ideas. We've been building weight in the most logical portfolio for us, which is our global macro portfolio. We've been building some ADR weights in some of our other portfolios. But this is, I think, an important shift, and we're always looking for these important shifts. And it tends to be global stocks do well in a reflationary environment. So it fits with the picture we're seeing in financials, industrials, and materials. Of course, lots of global markets have significant materials exposure, and lots of them have significant financials exposure. So let's just still get some internal indicators I think are important. We did have some sloppiness in stocks today, but look at VIX. The VIX, or a measure of volatility as priced into options, has really come down from elevated levels over the course of the last year. This is the market basically saying we don't expect major volatility. When we look at credit risk, or the amount of excess return a bond investor is demanding to buy a corporate bond as opposed to a sovereign bond, credit risk has been coming down since around the time the stock market bottomed in October. That continues to be the case, and certainly not elevated like it was in 2020, which in fact was much lower than where it was back in 2008-9, where lots of people like to compare today's market to then. There is no comparison. So I put this up a few weeks ago. This was, I thought, a pretty good checklist for a market bottom. In June and October, we had a washout in breadth. The percent of stocks in uptrends got exceedingly low. We got to exceedingly bearish sentiment. You want to see a big pickup in demand for stocks, and that's what we're talking about, a breadth thrust, which we saw in October and again in January, highlighting that 12 months forward, 100% of the cases were positive back to 1957 when we had that kind of breadth thrust. Now, interesting, when you had a breadth thrust but the biggest pullback you got in a market that succeeded was a little over 6%, and we pulled back about 5.9% off the highs in February. You have a retest phase. Well, in December, the NASDAQ retested the lows, but there were a lot fewer new lows and price momentum was improving. We had a bread thrust, as we talked about. The weakest parts of the market have a bounce. Well, we know in January, it was a junk rally. The most unprofitable trades for 2022 had the best month in January in 23. There's some renewed risk appetite. We know the groups that we're focused in are more economic risk sectors. A rotation into cyclicals and beta. We've talked about how high beta has been outperforming low beta. We have seen less volatility, which we looked at on the last page. So the next piece we want to see is improving macro and earnings expectations. Well, the macro data in some areas is improving, and there's still questions around margins on the earnings picture. So these are things that we have to continue to watch. But I think we're working our way through this list. Last couple of things. We have to remember that markets run counter to the economic cycle. This is a measure of CEO business confidence expectations for the economy over the following 6 months. When they become the lowest, they line up with market lows. So we saw that in 2022, and we saw a significant low in the market in October of 2022. We've seen the market rally since then. Likely, it is not going to be that somebody rings a bell and says the data's better now, time to buy stocks. Market will try to anticipate. Last thing I want to leave you with. I talk about how it's important to look at breadth across a broad universe of stocks. This is an index called the Value Line Geometric Index, going back, well, in this case, to 1974. You can see that of 1,700 companies on the NYSE currently, if you equally weight them, actually from 1998 until back here in 2020, they basically had moved sideways for over 20 years with a brief period of outperformance in 2017-18. But we finally broke out with strength in 2021. So again, that's the beginning of a new bull market for the average stock. And in the bear market of 22, pulled back and retested the top end of that range and then turned higher. This is a little cutout of that bottom chart. And we highlighted over the last few weeks the reverse head and shoulders pattern, left shoulder, a head, and a right shoulder. So for the average stock in the US, it looks as though we've been through actually a long consolidation range. The S&P 500 and the NASDAQ 100 way outperformed this index. But over the last number of months, small and mid-cap stocks have outperformed. So I'm all about trying to find big structural changes. People look backwards. They want to know when the NASDAQ 100 is going to lead again. And they want to know when the biggest companies in the S&P like Apple and Amazon are going to be the stocks to own. It may be we've been through a structural shift. It may be that the most economically sensitive groups like financials, industrials, and materials, which have underperformed for years and years, but have outperformed over the last 18 months, are only in the early innings. It may be that small and mid-sized companies are in the early innings of outperformance. It may be that global stocks, as opposed to US stocks, are in the early innings of outperformance. And it may be that bonds are in the early innings of a long bear market. But the tendency is to go back to what worked before. In the month of January, there was massive flows into bonds. There was massive flows out of stocks. And my guess is these folks are going the wrong direction. So we want to be there for the next run higher. I see very solid evidence that we've been through a corrective period and that it's coming to an end. And it's not going to happen all at once. There's going to be weeks when the data is a little bit bumpy, inflation's a little hotter, or earnings come in a little weaker. But the market is a machine of 1,000 moving parts. And the sum total of all those moving parts create a price outcome. And so I don't want to get too caught on any one piece of economic data or any one piece of inflation data. We have to look at things in the aggregate and the way the market's handling it. And I would say the market is grinding through this data, and we've been working our way higher since October. My guess is over the next few months, market continues to do quite well. So with that, Pamela, if there's any questions, certainly happy to answer them.
Yes, Dave, we do have one question here from Lawrence, one of our regulars. He wants to know, David, how you feel about new purchases when a sector or an equity has already had a good uptrend. Does Barometer typically wait for a pullback, or do we often prefer to buy into that uptrend?
Well, that's a great question. It depends how established the uptrend is. It depends how quickly the stock has run. It depends on a lot of things. Let's just take it from the top. First of all, if our breadth data for the equity market is positive, we're looking to add new ideas. So as it stands right now, with the NYSE breadth data having pulled back over the last 4 weeks, we're not adding a lot of new positions, right? We're not looking to add new positions. In Canada, we are. And globally, we are, because breadth data is supportive. From a sector perspective, we're only looking to add in sectors that are showing us expanding breadth. So we've seen breadth data pull back. We're not putting on new positions. And then when we look at single securities, is something extended away from the 200-day and 50-day moving average? Because when that happens, often you'll see it pull back towards the moving average and consolidate. But, you know, we're not afraid to buy something in an uptrend, because once something's in an established uptrend, it can rally for a long time. So, you know, I'm simplifying when I say we want to buy uptrends. We want to buy where the wind is at our back, but we don't want to step up and buy things that are way extended away from the moving averages, because we know they have a tendency to come back in and retest the moving averages. So things aren't going to move straight higher from here, but we know there are several very good themes in place. And similarly, when a group starts to underperform, it can underperform for a long time. So we don't want to buy things just because they're pulling back in price, because it could be the beginning of a bear market, not the end. So I hope that helps in some way.
Thanks so much, David. Yeah, that concludes the questions we received this afternoon. As always, a great presentation. And for those of you who might have questions that you'd like answered offline, please feel free to reach out to us. We're available pretty much 24/7 these days, right, Dave? And with that, I'll leave you with the final word.
We watch pretty closely, and you know, I encourage people, if you're interested, to follow us on Twitter as well. We're pretty active there. And but if you want to have a conversation, please don't hesitate to give us a call, and we'll answer questions and hopefully be useful. So thanks everybody for joining us today. Pam, thanks for hosting.
Always a pleasure.
We'll see you again next Tuesday.
You bet.